Hello and welcome to Jazz After Dark, everybody. How we doing out there tonight? Good. Hope everything is good with you. We are going to talk about something interesting here tonight. Hope you've got yourselves a little drink. I've got myself a half old-fashioned, you know what I mean? A little water tonight, but got a half old-fashioned in this fancy little cup here. It's got a little finger holder. Seems like that's what that's for, huh? Anyways, we, Buffalo Trace in the old-fashioned, by the way. We track really everything that we can here, and as it pertains to what we're doing. So we manage our own funds, and we do it in a way where clients can see all the internal positions and they participate in those. So instead of buying an ETF for one price and then coming the end of the year and you go, Dustin, let's do some tax loss harvesting. And I go, well, you have one thing. You bought a bunch of one ETF or 3 ETFs or whatever, and they all went up. So there's no tax loss harvesting. We actually build, we call them free TFs, kind of jokingly here, but it's a fund, but you own all the positions. So we can break that little mock ETF up and say, well, let's adjust some things. Maybe you don't want to invest in tobacco. Maybe you want to sell off some losers and take advantage of tax loss harvesting in other accounts. Maybe it makes sense to try to do like a wash sale across the board. And so a lot of times clients get to the end of the year and they're like, I didn't even know I could do some of this stuff. Because of that, we have a lot more to track. There's really something interesting going on, and I have debated talking about this because it may be a little much, but I've tried to make this super simple here. And we said that this year on Jazz After Dark here, our show, we're going to go that extra level deeper. So I want to bring you into kind of what like the institutional people look at for a moment and see if you can follow along. And I'm sure you'll be fine, but what I'm going to point out is that we're at a point now officially where all of the stock that was bought during COVID and beyond, right, during that whole rally, by retail investors, you, right, just the average person, not the institutional players that have to report their holdings, but just you out there, buying and selling stocks. All of that stock that you bought, we now know has all officially been sold. And it may not be that you physically had bought a stock during COVID and now you've sold it, but as a whole, everybody that bought all that stock, all those positions have been sold. Take a look. So we can actually track retail investors, and we're looking at both the NASDAQ 100, if you follow the NASDAQ, 100 stocks, and the S&P 500, okay? And so what happens here is if we go back far enough, during COVID, look at the NASDAQ, the dark blue line. During COVID, people chased stocks, individual stocks. And, it was all the hype. You guys were excited to do that, and so was I. And the S&P here is in light blue, and we have a lot of individual stock buying. Well, through last year, and now going into this year, all those positions, and then some, have been sold. We measure this by market cap, and so we can kind of see the difference between pre and post-COVID, or what we're calling post-COVID, the end of the pandemic, so to speak. And so you have a question, right? If you see a data point, remember, anybody that shares data with you, ask the question why. Like, what do I do with that? Or why are you telling me this, right? If we could do that, we'd all probably be a lot better off, politically and financially and stuff. So let's go a step deeper. If we know that those positions have been sold, going before COVID all the way through and now after, all those positions are gone, where'd the money go? Those aren't losses. That's not a bankrupt trade. So where'd the money go? That's what we want to know, because maybe we want to participate. Maybe there's money moving somewhere where we could tag along and participate. So actually really cool. And I won't take long here, but we can compare and say, well, let's go look at some other stuff and see if there's anything that did well. Well, individual retail investors, here's the money that went into ETFs. Well, that kind of coincides with all of this in here, right? Money going into ETFs to participate through COVID. Money came out of the NASDAQ and S&P after COVID, but yet it keeps going here with ETFs for retail investors. Huh. All right, so money's going there. We can also easily track professional investors and any of the corporate bonds that are in ETF format. Most people won't participate in actually buying a corporate bond. You can, but most of us retail investors, we won't go that far and think that through, nor do we have the platforms to do that. Market Access, by the way, is the platform that pretty much has a stranglehold on the industry. And so we can see that they're not doing it. So it's the retail investor buying these ETFs. Okay, well, so that's one thing. So we could say money left the individual stock market, Apple and buying stocks or whatever, and we moved over to ETFs. So that's diversity. So basically what happened is people said, I had fun with the stock game, and I'd like to get back to that, S&P, set it and forget it. You can't beat the market sort of thing, right? Notice how all those people that were like, you shouldn't pick individual stocks and, you got to just stay the course and everything. Notice how they just disappeared during COVID? You didn't hear a lot of that. You heard a lot about like, oh, NVIDIA, look at it go. AMD, well, Intel, look at the biotech stocks. Oh my God, Pfizer. Right? So the excitement was there, and all those people that said, let me just buy and hold the market, they got sucked into that. But we now know that they have since shifted back to ETFs on an individual sort of basis, right? We know that the institutions aren't causing this. We know that normal corporate bond buying in ETFs, which is a big area that we track, that's not causing it. So people want to be more diverse. In other words, they say, the stock picking days are over. I got to get back to work, right? I got my job back, whatever. I went back to the office, and now I've got to go into ETFs. I don't have time for all these stocks. Okay. All right. Is there anything else that we could look at? And I already know the answer, but I'm saying this in jest, right? So we know that people don't want to be in individual stocks. But did the money leave the market? So we know it went into ETFs, but did it go into the S&P type index fund ETFs? Did it go into like retail only, like the XRT or the RTH? Did it go into commodities? Did it go into gold, like money markets? Like what happened? Where'd it go? Because if it's leaving the market, then that means it's going to be very difficult for the market to come back unless we convince all those people to come back, right? So that's where I'm going with this. Let's take a look. So I'm calling this risk off-ish, right? So here's the same flow into equity ETFs. So a lot of money consistently diversified itself and said, no individual stocks, let me pick an index ETF and just go with that. Could also be a sector-based ETF, but basically broad market participation. And then down here, we've got mutual funds. And I just put this here because I wanted to show you nobody's buying mutual funds, right? It's kind of out of favor, right? So everybody now easily can buy an ETF with your phone or whatever. Mutual funds, you can still do the same thing, but nobody wants to participate in that. However, what's this light gray line? Lately, money has what? Gone into money market funds. Now, this little piece right here, I tried to highlight the fact that this little piece most recently is not necessarily the money leaving the market and going to those money market funds. What's happened, and I can attest to this because we've had, like every client ask this question. I have money in my basic banking savings account. It pays 0.16% or something irrelevant. Dustin, what if I just go buy a money market fund? I'm not using the money right now, but it's kind of emergency money and I don't want to take risk with it in the market. I don't want to be in an index fund, but money markets are paying like 4.5%, going on 5%. So if the money's just sitting there and I'm making 0.16, let me go over here. So in the last couple of weeks, we've seen that massive shift there. It's becoming really competitive actually for banks to compete for your dollars. Nonetheless, we go back over here and see as money was coming out of those individual stock positions, we have money going into safer money market type areas, right? Savings, CDs, the basic no risk or extremely low risk vehicles. Why is that? Now, this is a big one because are people really worried that the world is going to end or there's going to be a massive pullback? Sure, there's some of that. But to be fair, you market historians will know this. If we go back through the last 10 years, take out last year and then go back 10 years, right? We go back and you needed somewhere to put money to get really, low dividends. You take whatever you could get, right? Your only option was the S&P. At one point when it was yielding over 2%, people were like, that's incredible. There's nowhere else I can get 2%. I can't go to bonds. I can't go to bond ETFs. I can't go to money market funds. There was no money there at all. So money had to go into market. Think about what this means. Those people that are not 30-something anymore and need to have some safe money, or are within 5 years or 7 years from retirement, they need that safe money to draw down. They can't be investing in a stock market, but they had to, because the answer anywhere else was what? Negative real yield. Have you heard that word before? That's just a fancy way of saying the dividend or the interest that you collect from your bond is whatever, 1.5%, 2%, or whatever it was at the time. But inflation is greater than that. So you had a negative net return or negative real yield on the thing that you invested in. So fancy speak is to tell your friends, it was a negative real yield, man. That's what was happening. And now we have a slight positive real yield. But in reality, it just means the dollars that were returned from your interest really lost more value than what you gained. And so what's happened? Now we have people that are in retirement say, I was in the stock market, I was getting 2%, but I can go in this thing over here and it's super safe, 4.5% or more now. And there's no risk, essentially, right? It's just cash being paid back to you. So let me think, the wild volatility and the mess of the market, or let me go over here with my safe cash, maybe first 2 or 3 years of retirement money and put that over there nice and safe and actually make something off of it this time because inflation's coming down, or at least be even. And so money coming out of the market was not just a combination of people going back to work and COVID being over and, the government's not giving us any more money, so I have no more to invest, right? That's part of it. But money's really coming out of the market and going to safety because that's where it wanted to be the whole time. Historically, over the whole generation of the markets, there's always been, mostly always been a place to put safe money. U.S. Treasuries, that's what they're there for. You put money in there, you make a few percent, but there's no risk and you'll get paid. Money market accounts, okay, that's fine. Money market funds, money market ETFs ever since the 90s when they came out. And they go, I've got a place for the safe money. But for the last 10 years, minus last year, the only option was the stock market. So there was an extreme amount of risk in there. People's real full retirements were on the line there. Well, now we can see that we're coming all the way back to where we started. And that's a good thing. There needs to be that. But I want to point out the fact that the stock market can't have, I've been saying this now, can't have these massive rallies without that kind of money. Like everybody invested in the stock market because there's nowhere else to go. We all have choices now. And so now we don't have that kind of money, which means when there's really good news, we can't have an 8% rally and just tear off in one direction. Just can't. There's not enough money. Very cool. I thought that was a way to break down something that maybe could be complicated, but we could simplify it and kind of point out what's going on there. So I hope that helped you guys out. I hope you learned a little bit and enjoyed that. We will keep doing that. I've got more to share with you tomorrow on the closing beat, of course. Hope you'll join us for that. It's a live show that we do every day at 5 o'clock Eastern time. Otherwise, hope you enjoyed tonight. I already said that. And what time is it? It's 11:48 at night here. So I've got to get back to work. All right, you guys enjoy. Thank you for watching, and thank you for keeping us in mind. jazzwealth.com. There's our shameless plug for the day. If you want a financial advisor who is actively focused on everything I can do to get your dough straight, it's going to be us. Hope you check us out, jazzwealth.com, and enjoy. Adios.